Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way. What if I told you the U.S. Federal Reserve is about to intentionally, silence itself?
Yeah, and completely rewrite the rules of global finance while they are at it. It is a massive shift.
Right. So today we are doing a deep dive into the April 2026 confirmation hearing of Fed Chair nominee Kevin Warsh.
And this really isn't just your standard changing of the guard under President Trump.
Exactly. Based on the data and the recent analysis we are looking at, this is a proposed system reset. For a beginner, the Fed can seem, well, incredibly complex, but our mission today is to translate these high-level economic shifts into everyday terms.
Because it is going to impact your wallet, inflation, and the broader economy in a very real way.
Oh, for sure. But if you only look at the headlines, you might think the only drama is the political friction. The confirmation is actually delayed right now, right?
Yeah, it is. Republican Senator Tom Tillis is currently holding it up. He's pushing a probe involving the current chair, Jerome Powell.
So that could drag the process out past Powell's term ending on May 15th?
Exactly. But, that political delay is just the surface layer. And obviously, we were just looking at the mechanics here impartially, not taking any political sides. The real story is what Warsh committed to on the record.
Right, like how he stated publicly that the independence of monetary policy is absolutely essential.
Yes, and he clarified he made no promises to President Trump regarding interest rate cuts. He even committed to disposing of over $100 million in personal assets just to avoid any conflict of interest.
Wow, over 100 million. So he's drawing a line in the sand. But let's get into the actual mechanics of this system overhaul. Warsh is essentially pitching three main pillars, right?
He is. And the first one is a completely new data framework. Warsh wants to rely a lot more heavily on what are called trimmed mean indicators to capture underlying inflation.
Okay, wait, let's pause right there, because whenever I hear economists talk about trim data, it sounds, I don't know, a little suspicious.
Like they are cooking the books.
Yeah, exactly. Like if egg prices go up 400% or used cars suddenly plummet, you just cut those extreme outliers off the chart. Why would the Fed want to ignore extreme price changes? Doesn't that give them a false sense of security?
It is a valid question, but it actually makes a lot of sense when you look at how monetary policy operates. Interest rates are a really blunt instrument, and they work on a massive time lag.
Right, like it takes a while to feel the effects.
Exactly. If the Fed raises rates today, the real-world impact might not hit for 12 to 18 months. So imagine there's a short-term supply chain glitch that doubles the price of lumber.
Okay.
If they hike rates because of that lumber spike, by the time the rate hike actually cools the economy, lumber prices have probably crashed back to normal on their own.
Oh, I see. And then the Fed has just caused, like, unnecessary economic damage for no reason?
Precisely. They want to avoid a whiplash effect. By trimming the extremes, you filter out the noise of temporary shocks and get a clearer picture of the actual persistent inflation trend.
That makes a lot of sense. They are looking at the deep currents, not the waves on the surface.
And keep in mind, the Fed already shifted away from its 2020 makeup strategy back to flexible inflation targeting in August 2025.
Oh, right. The strategy where they let inflation run hot to make up for past lows.
Yeah. So Warsh is really just tweaking an already modified system, not starting entirely from scratch. But his second pillar is where things get really interesting. He wants to severely curb the Fed's public communication.
This is the part that fascinates me. Because right now, being an investor watching the Fed is, well, it is like being a passenger on an airplane with a really nervous pilot.
It is a great way to put it.
Right. Like imagine you were flying and every 5 minutes the intercom clicks on and the pilot says, folks, we see a cloud bank. We might change altitude in 10 minutes. Oh, wait. The wind shifted, we might stay here.
It would be terrifying.
Exactly. It makes everyone panic. You end up overanalyzing every single word. Is Warsh basically saying the Fed needs to just stop making announcements and fly the plane quietly?
That is exactly what he is saying. For years, the Fed relied on forward guidance, telling the market what they plan to do months in advance. But Warsh argues that all these officials constantly talking about rate paths has actually created policy errors.
Because the market reacts to the speeches instead of the actual economy?
Yes. By silencing the noise, the market will have to rely on the actual data rather than daily speeches from 12 different Fed officials.
So if they stop talking so much and focus on quietly fixing the economic engine, what does that mechanical fix actually look like?
That brings us to his third pillar, which is shrinking the balance sheet and returning to interest rates as the main tool.
Okay, the balance sheet. According to the research, this is a massive stockpile of assets sitting at, what, $6.68 trillion?
Yeah, 6.68 trillion. And shrinking it isn't just about being strict or hawkish. It's a total redesign of their policy tools. Experts like Stephen Mirren are talking about using liquidity rules and stress tests to shrink this by up to $2 trillion.
$2 trillion. That is a huge amount of money to drain from the system.
It is. And Fed officials like Lori Logan and John Williams are highly supportive of this. Here is the crucial concept. Shrinking the balance sheet naturally pushes long-term interest rates up.
Wait, long-term rates go up when they shrink the balance sheet.
Yes, because they are not buying as many bonds, demand drops. So the yield, the interest rate, has to go up to attract buyers. And because long-term rates go up, the Fed might actually be able to keep short-term policy rates lower.
Okay, let me make sure this makes sense for a beginner. Tightening one thing allows them to loosen another. It is like driving a truck, right?
Okay, let's hear the analogy.
So imagine you are driving a pickup truck, but you are towing this massive, incredibly heavy trailer. That trailer is the $6.68 trillion balance sheet.
Right, it is dragging you down.
Exactly. To maintain your speed on the highway, you have to press the gas pedal down really hard. The gas pedal is the short-term interest rate.
I love this.
But if you finally just unhook the trailer, you drop the balance sheet, your truck is suddenly light, you don't need to press the gas nearly as much to keep moving forward. Is that basically what Warsh is trying to do?
That is a perfect analogy. Unhooking the trailer changes everything. If Warsh achieves this lower short rates, higher long rates dynamic, it creates massive global ripples.
Because higher U.S. long-term rates attract money from all over the world, right?
Exactly. It puts immense pressure on European and Japanese bonds. Investors pull their money out of there and put it into higher-yielding U.S. treasuries. That increases global credit spreads and makes the U.S. dollar incredibly strong.
Which sounds great for us, but it can cause major trouble for emerging markets trying to borrow money.
Oh, absolutely. It makes their dollar-denominated debt way more expensive. So the Fed is completely rewiring its machinery. But there is a massive, unpredictable force hitting the economy right now that could just throw a total wrench into this delicate process.
You were talking about artificial intelligence.
The AI paradox, yes.
Looking at the data, Warsh used to claim AI would lower the cost of almost everything. But at this hearing, he was much more cautious.
He was. He noted that while AI boosts output and lowers prices eventually, the timeline for how it actually hits the job market and inflation is totally uncertain.
And the Fed is actively stressing over this.
Big time. The March FOMC meeting froze rates, but their April 8 minutes showed some officials were actually open to rate hikes if necessary.
Wait, hikes, not cuts.
Yeah, hikes. And then on April 17th, Governor Waller warned that extended high energy prices could trigger both sticky inflation and a job slowdown.
Wow.
The market has definitely noticed. Money markets have practically erased expectations for any rate cuts this year, even though a few brokers are stubbornly predicting one or two.
You know, this really pushes back on that common tech bro narrative we hear all the time.
Which one?
The idea that AI makes everything instantly cheaper. It is like a magic wand. But I think of it more like a home kitchen remodel.
A kitchen remodel. How so?
Well, ultimately, a new high-tech kitchen makes cooking faster, it is more efficient, you save money in the long run. But during the remodel...
Oh, it is a nightmare.
Exactly. Your house is a mess, you are paying an absolute fortune for contractors and raw materials, and you have to buy expensive takeout every single night because you can't cook. Aren't we basically in the expensive contractor phase of AI right now?
That is exactly what the data shows. AI is not an immediate disinflation magic wand. In the short term, it creates massive bottlenecks.
Because you need physical things to build it?
Right. It creates massive price pressures for power, advanced semiconductors, data centers, and grid infrastructure. That is why the Fed cannot simply cut rates just because, AI is here. They have to manage the inflationary spike of the remodel.
Okay, so if AI is acting as this expensive remodel and the Fed is completely changing how it steers the economy, how does an everyday investor even navigate this totally new landscape?
Well, based on the data, the very first thing investors need to do is stop viewing Warsh as just a dove who wants to swoop in and cut rates to save the stock market.
Right, this is about restoring trust and realigning the whole policy structure.
Exactly. And this debate is spreading fast. On April 21, Governor Waller publicly proposed centralizing the regional Fed operations.
Wait, centralizing them, so taking power away from the regional banks?
Yes. It proves that this idea of a system reset,
Yeah.
a quieter, more mechanical Fed, is
Mm.
becoming the mainstream view inside the institution itself.
So what are the actionable insights here for the listener?
First, don't blindly throw money at long-term bonds or high-valuation growth stocks just because they slap AI on their pitch deck.
Because the short-term costs are too high.
Right. Focus instead on the companies solving those real-world bottlenecks we talked about. Companies dealing with power generation, industrial automation, chip manufacturing equipment.
The companies selling the shovels during the gold rush.
Precisely. And second, understand that the U.S. dollar and U.S. long-term rates are the absolute center of the global financial universe right now.
So just to summarize this for our beginner listener, the era of holding your breath, waiting for a Fed official to get on a podium and save the day with a rate cut, that era is pretty much over.
It is entirely over.
With the next FOMC meeting coming up on April 28 and 29, 2026, the market is going to be wildly sensitive to actual data and the mechanical results of that meeting, not just rumors and speeches.
I agree completely. If the Fed signals less frequently but more densely through their actions, we will likely see much higher volatility in interest rates, foreign exchange, and stocks around those specific meeting dates.
It is a market adjusting to a total system reset, not a market waiting for a pivot.
Perfectly said.
Which leaves me with a final lingering question for you, the listener, to ponder on your own. If Warsh actually gets his way and the Fed stops talking to the public, if they rely entirely on cold, hard data and mechanical balance sheet adjustments, what happens to the market's psychology?
That is the million-dollar question.
Right. We have been trained for a decade to rely on the Fed's comforting words whenever things get scary. Will a sudden wall of silence actually cause more panic and volatility than the overcommunication ever did? It is definitely something to think about. Don't forget to subscribe and hit that like button.